So most investors are invested in the US stock market comprised of the S&P 500. So they probably think that they're very diversified, but they're not. And the reason is the top 10 stocks in the S&P 500 comprise 33% of the index. However, they only make up 25% of the earnings. And on top of that, most of these top 10 stocks are tech related. The last time the index was this concentrated was in the tech bubble in 2000, when these top 10 stocks comprised 27% of the index. And we did have a serious correction after that. You can diversify between sectors. And the reason is different sectors tend to outperform in different market environments. So for instance, if we're in an inflationary market environment, those input costs that cause that inflation tend to be where you want to invest your portfolio. So things like energy, materials. In a recession, where investors are very concerned about what that future trajectory is for earnings, then you want to be in those companies where earnings tend to be more stable, like utilities, communication services. In an environment with interest rates rising, you want to be in a sector where you can actually pass on those higher interest costs. That tends to be financial services. So investors should also diversify amongst asset classes, equity and fixed income. So fixed income, as the name describes, you get a periodic payment. And that's usually a fixed amount. And as a result, when interest rates rise, fixed income prices tend to drop. And equities, you own part of a company. So companies tend to do well, and stocks tend to do well when the economy is expanding. So fixed income and equity tends to move in opposite directions. I know it sounds very complicated. That's why we have a one-stop solution, the Brompton Enhanced Multi-Asset Income Exchange Traded Fund, or BMAX on the Toronto Stock Exchange. It has 70% in global equity across all 11 sectors and 30% in preferred shares. It pays a monthly tax-efficient distribution.